Hello there. I'm Holly McDonald with the Costa Mesa Pod, OC Pod, whatever you want to call it, vibe. And today I have my guest, Jason Thibodeau, with me of JMJ Financial. Jason is
Hi.
amazing. Thank you for letting us film here.
Only when I sleep well.
So Jason leads JMJ Financial here in Huntington Beach and has so much insight about what is going on in the market today. So I know we just had a holiday yesterday, but November typically slows down a little bit. What are you seeing right now? I mean,
Right.
2025 has been kind of a weird year.
Yeah, it's interesting. It is a weird year. And like you just alluded to, real estate is seasonal. So traditionally, what we're used to is during the holiday season, we see a noticeable slowdown. And I would say that to a certain extent in general, maybe that's happening. But for us right now, what we're noticing is no let up. We're at about 60 active transactions right now. And that's just about as busy as we've been all year.
Yeah. Wow.
So I'm a little bit surprised by that. I think there's probably some pent up demand because, people have at the end of the day been frustrated, we'll call it, with 7.5%,
Yeah,
8% interest rates.
Yeah.
And I think it's easy for us to forget and get used to this new normal. And this new normal has been hovering more or less on an average 30-year fixed of 6.25%.
Mm-hmm.
And so what's been so frustrating in the marketplace for consumers, realtors, lenders, is that when we saw before dips in interest rates,
Yeah.
what ended up happening is the rug would get pulled and then they'd go right back up.
Sure.
Right? We'd be like, oh, finally. And again, we're not looking for obnoxiously low rates.
Yeah.
What we want is normal. What we want is balance.
Right.
But every time in these last 3 years with the Fed's higher for longer policy, we've seen the dip. And then within 2 to 3 to 4 weeks, boom, they shoot right back up to 7.25%.
It's like 2 steps forward,
Yeah.
step back.
Yeah. Or for 3 years, it was 1 step forward and 2 steps back.
Mm-hmm.
So it's been really frustrating. So what we've been lacking, in a word, with these lower rates is duration,
Mm-hmm.
where
Yeah.
it hasn't just been 2 to 4 weeks. Now we're stringing together months.
Right.
And it does take consumers some time to catch up with that reality, where they're like, oh, okay, well, maybe. But now that they've been around for however long it's been, I think we're approaching almost 6 months of interest rates sub 6.5%. That's probably the reason we're seeing seasonally things not go down as far as it should.
Yeah, it's basically, it's getting it into people's head and then like reinforcing that, hey, the rates are still low. They're still low. They're still low. So it's starting to
Get
to
baked
stick.
into the consumer psyche.
Yeah.
Whereas before, in their mind, I'm not buying 7.25, right?
Yeah.
They're like, what, 6.25? And it's staying. So
Mm-hmm.
that's probably why.
Yeah, and I think a lot of times people are, they're just waiting. They've been told for so long that 2024 is the year that the rates will come down. 2025 is the year the rates will come
They
down.
kind of give up.
Yeah.
Yeah.
And like you said, there's pent up demand. People
Right.
are living their lives. People are, it's been 5 years since COVID. A lot of people had to dramatically shift their lives
Yeah.
then. And people, they don't stay planted in the same place forever, typically.
Well, household creation.
Yeah.
The biggest generation in the United States right now is the millennials.
Yeah.
And what's happening is they're on average, let's say roughly 35 years old right now.
Mm-hmm.
And they were late bloomers as compared to baby boomers or previous generations. But at 35, what's happening? People are getting married.
Mm-hmm.
People are having kids.
Yep.
They need shelter. Maslow's hierarchy of needs, the basic form or need is shelter.
Yeah.
So that's traditionally what's happening that I think a lot of people just forget. The millennials are coming of age.
Very, very true.
Yeah.
Yeah. So we're seeing a lot of that. What can you say regarding the news headlines that have been out there over the last few days, like maybe the last week, about talks of a 50-year mortgage product? What do you think about that? Or maybe you don't want to share what you think.
I'm going to think, no, I don't mind. I'm not a fan.
Mm-hmm.
I'm sure the banks love the idea,
That was my initial
right?
thought. Yeah.
Because the thing is, like, a 30-year fix to begin with has front-loaded interest.
Mm-hmm.
So the vast majority of your payment is interest.
Uh-huh.
Let's just call it a $2,000 a month mortgage payment. $1,750 is going to be interest in the beginning.
Yeah.
Now, when you spread that from 30 years out to 50, the banks are really excited about this concept because you're just going to be paying them interest for 50 years instead of 30 now.
Yeah.
And I understand the idea of slightly improving cash flow.
Yeah.
But any consumer can do this experiment if they want to. Go ahead and go on any mortgage calculator on your phone, take a $750,000 mortgage, do a 30-year fixed versus a 50-year fixed
Yeah.
at 6.25%. And you tell me, is there much of a payment difference? Yes, there's a payment difference, but is it as much as you might think? No.
Yeah. And do you think the interest rates would even be like similar?
Yeah, that's a good question because it opens up a lot of other questions about what banks would charge for a 30-year fix.
Yeah.
And I think the interest rate would probably end up being higher than a 30-year fix because in the logic of what we already have access to, a 15-year fix, it's a lower interest rate, right? Than a 30-year fix. Well, carrying that logic to 50 years, a 6.25 would probably be 6.5 or 6.75 spread out over 50 years, thereby further reducing the cash flow improvement, right? So I'm not a fan of the idea of locking people into paying banks 50 years of interest. The frustrating part for people in our industry and mortgage is what we've been asking the new HFA or whatever the acronym is, Pulte is his name. We're not cheerleaders of any political persuasion, but LLPAs, loan level price adjustments, are the things that are keeping interest rates higher than they need to be.
Okay.
And it's basically two things: your FICO score and your down payment that decide what your loan level price adjustment is.
Yeah.
And those loan level price adjustments over the years have done one thing and one thing only. They've gotten more expensive.
Yeah. Okay.
And if we're going to fix what we feel is a problem in the mortgage industry, it's the administration needs to fix loan level price adjustments. What it feels like instead that they're throwing out there is these gimmicky ideas like a 50-year fix. Politics aside, I don't care who you voted for. What we're looking for as advisors are things that will actually help the consumer. And I think fixing the LLPAs is what would do that, not a 50-year fix, with all due respect.
No, that makes a lot of sense. And I think part of the goal and aim of the American dream of owning a home is that you can build your wealth and have your legacy crafted. And with expanding the length of the loan term, that doesn't necessarily
Straps
help
people.
you.
Yeah.
It doesn't help you grow your wealth as quickly.
Yeah. I mean, I get it. Technically, if you owned real estate for the long run, could you still up on the right side of profitability? I think so, yes. And I'm not saying it can't work, but is it the best idea? Right? Probably not, in my opinion. That's my humble opinion I'll throw out there.
Yeah, no, that makes a lot of sense.
I think they're eventually going to get to the LLPA thing that I just brought up. I think they're starting it with the announcement that Fannie Mae made with the removal of a credit score minimum.
Yeah. Well, you brought that up.
Yeah, sorry. 620 FICO was the old minimum FICO requirement. Fannie Mae is going to be removing that, is what I'm hearing.
Yeah.
Now, again, the question is, should somebody with a 580 FICO score be buying? And it depends. Some people have extenuating circumstances where it actually does make sense and they are creditworthy, and you just have to work through that. What we don't want to see happening is folks who aren't creditworthy trying to buy homes, because that's going to set everyone up for financial failure, quasi 2008-ish with subprime mortgage crisis, right?
Right. But
so they have to be careful with that.
Yeah. I mean, from what I read, the whole point is to look at like the holistic overview of the buyer.
Right.
So everything, their employment, their credit score, what they have in the bank, a whole picture, which essentially you do now. However, people are oftentimes just told they don't even have an opportunity based upon the credit score requirement now. So it eliminates them right off the bat, which is discriminatory. So I can see why they're doing that.
Yeah. There's always FHA, and that's what FHA was designed for. Is it's not a FICO score driven product.
Yeah.
I actually like FHA a lot more personally.
Yeah.
For folks who have lower credit scores for whatever the reason is. Because maybe, like you alluded to earlier, they have compensating factors. They've got more money in the bank. They've got great income.
Yeah.
Because with going back to what I talked about earlier, LLPAs.
Yeah.
LLPAs, if you do, let's just say Fannie removes the 620 FICO score requirement, you've got a 585. Well, there's still LLPAs, so your interest rate's going to be astronomically higher, and so is your mortgage insurance with conventional as compared to FHA. Because with FHA, not being a FICO score driven program, you can get the same credit interest rate with FHA at 580 technically that you could with 680.
Wow. Yeah.
All right, and that was the whole idea of the FHA program after the Great Depression. Franklin Delano Roosevelt, the Great New Deal, was trying to encourage home ownership for folks who wouldn't normally qualify. That's the whole spirit of the program.
Yeah.
So in my opinion, FHA is probably the better bet anyways. So it kind of makes this whole thing about 620 FICO removal a moot point, in my opinion, with conventional.
Yeah. Well,
We got to talk to a mortgage advisor who knows what they're doing.
we really need to dispel, what's out there in the air about FHA loans, because some people just don't favor them, like when they're the seller or even like the listing agent.
Sure.
If you're competing against a conventional
Yeah.
or whatnot. But it doesn't mean that with FHA that you need to do the minimal requirement anyway. You don't have to do 3.5%. Like I've seen people do much higher depending on their, financial ability. So there's different options.
Plenty of people do FHA with 5 and 10 and 15, and sometimes it can make sense with 20% down. It just depends, right? There's no one size fits all.
Yeah.
And as far as like the stigma tied to FHA from, a seller or a listing agent's perspective, there's nothing wrong with an FHA loan. That doesn't mean they aren't going to perform or anything like that. FHA has been really modernized. I think there's some old legacy stigmas tied to FHA that aren't really relevant anymore. Like, sure, if you've got lead paint, chipping and peeling paint, or things like that in your home.
Broken glass. Yeah.
I'm sorry, it's going to get called out.
Yeah.
But if the home's in, it doesn't even have to be in turnkey situation. If it's in livable condition, you're going to be fine. We close tons of FHA loans, tens of thousands of FHA loans close every year, if not more.
Yeah. No, I mean, it's just great for people to
VA
have
too, by the
options.
way. Shout out to veterans.
Very aptly
Yes.
positioned this week. Yeah, the VA loans are great. They're a great opportunity for people in those circumstances too, and I think
We
it's
can close
wonderful.
fast with both VA and FHA. We've closed 15 days or less with both.
I know. Jason's helped with
Yeah,
that.
there you
It's
go.
Amazing.
Shout out to Jason Thomas.
Yes, and
You
also
better be listening to this right now, sir.
herpes watching.
Is that me? Yeah. Just hit snooze or whatever. We have I'm the culprit here. My phone's going off. Sorry.
It's no problem. I just have one other question for you that I think would be interesting to hear your stance on. But when we were talking about 30-year loans versus 15-year loans, I know there's not one size fits all, but in your opinion, what makes more sense?
Oh, that's a great question. I actually really like this topic.
Okay, good.
I think unless you have enough money to pay cash for a home, you should not be in a 15-year fixed. Because
Why?
So I understand the concept, right? Let's just say right now you get a 6.25 30-year fixed. Well, you could probably get a 5.75 or a 5.625 or maybe even a 5.5 with a 15-year fixed, right?
Yeah.
So the interest rate, so the draw of a 15-year over a 30-year is not just the lower amortization, more aggressive payoff.
Yeah.
It's also lower interest rate. Now, here's the thing. If you're a working family with kids, okay?
Yeah.
And, you've been told by certain people in the media, you got to do a 15-year fixed. It's and then you lose your job, right? Well, you've just obligated and strapped yourself while you're saving interest, yes, and while you're paying your mortgage off more aggressively, yes. You've also obligated yourself to a pretty hefty payment every month. So the life hack with mortgage is while you can't necessarily have that lower interest rate that a 15-year supplies, what you can do on a 30-year mortgage is make the equivalent to a 15-year payment. So if something comes or a financial hardship, this is what I explain to borrowers when they're not thinking about this stuff in the big picture. 3 to 5 to 7 years from now, we don't know what's going to happen in life. If there's an economic downturn or if there's a financial hardship, a chronic illness, God forbid, whatever it is, in my opinion, if you have the ability to make the payment, go ahead and do the 15-year payment, set it up with your servicer on a 30-year loan. But the moment there is a tight squeeze for something that was unexpected, Now you're not obligated to make that payment.
Yeah.
And sure, and by the way, you're still saving an interest when you're accelerating the payoff like that on a 30-year.
Yeah.
It's not quite as much as the 15-year interest rate, but it's pretty darn close. It's insurance. It's making sure you're not setting yourself up in the long run for financial failure. If you have tons of money and you can pay cash for a home, but you want to use the leverage and you're okay with the 15-year payment, obviously that's the right choice. But if you're a younger family, let alone a first-time home buyer with a lot of obligations and you want to plan for potential uncertainty, I'm not a fan of the 15-year fixed.
That's a really good viewpoint. I think a lot of people would appreciate knowing that.
Yeah.
And again, I think it's also just good, like you said, no one size fits all, because you might be that borrower that has the ability to pay cash, but just wants to have that flexibility of having the payment. Yeah. So everything is very situation dependent, which is one thing I like about obviously working with you guys too, is that it's not just a file that comes in when people submit an application.
It's a human being.
Yes,
Yes.
exactly.
Everyone has their own financial philosophy. Everyone has their own risk tolerance. The idea of selling somebody some exotic product aggressively when it may be completely inappropriate for their way of being in the world. Like, you have to have some sort of emotional intelligence to connect with your borrower to really understand what their risk tolerance and financial philosophy is.
Yeah.
Right? You don't want to be barking up the wrong tree. Each product in its own right is just fine.
Yeah.
When applied appropriately.
I have
Right.
a great idea for you guys. I'll talk about offline because I'm not going to share the secret sauce here. But yeah, that's very good wisdom and information. You always have such great wisdom. That's why we love J&J Financials.
I appreciate that. Thanks. My wife's going to think I'm going to get too big of a head when you say stuff like that, but thank you.
Well, your office is beautiful. Thank you so much for...
Thanks for joining us at the grand opening open house last week. That was fun.
So great.
Yeah.
Oh my gosh. I think people will be talking about that for the rest of the
Stay
year.
tuned, by the way. We're going to, in the beginning of the year, aside from the forecast event, because we're going to do the forecast event again, Logan Motashabi, Stephen Thomas, we're also going to do a collaborative car show. And this parking lot's perfect for car shows because it wraps around.
Is that the person that was just here?
On a Saturday. So it's going to be a lot of fun. We haven't announced that yet, but it will happen.
Oh, my son and I go to car shows in Huntington every Saturday morning.
Are you serious?
We go to the one at Donut Derelicts.
Oh, wait,
is
that the one on Magnolia? Yes, I hear them every Saturday morning. Yeah.
We go every Saturday unless we're out of town or something.
That's okay. So yeah, we're all car guys here. So it's been kind of a passion project of mine to do something that's JMJ sponsored.
Well, and this is the perfect location.
Yeah, right. The parking lot's perfect.
Do you have a month in mind?
No, it's probably going to be past the holidays, past the forecast event, and then past the heart of winter. So I'm going to say springtime, March or April.
I was going to say, let it get past the rainy season.
100 cars, Ferraris, Lambos, and old classics and all that stuff.
Yeah, that'll be so much fun. So stay tuned for that announcement too. All right, well, thank you.
Thanks for having me on. All right.
Bye.
Talk to you later. Bye.